Good evening, welcome to Ekcel Academy. I hope we are live. I hope you can listen to the audio as well as see the video. If there is any problem with respect to audio or video, if you're watching currently, please do ping me. So before we start the CMA revision session, where we'll be looking at a few of the questions from the question papers. So let us quickly go through the website of Ekcel Academy. Ekcel Academy, we have been into CS coaching since more than 10 years now. So if you haven't already registered on our website, please do register. This is our website, excelacademy.com, www.ekcelacademy.com, usual spelling except for the word Excel. Then there, once you go there, you can look at the courses tab. There, once you register and log in, you'll be able to watch few courses free of cost. You don't have to pay for those, obviously. So make use of that. You can see Indian Contract Act, drafting, then basics of accounting, corporate management, CMA, everything is there, in fact. And of course, the unique thing about Excel is that we offer the mentorship program, wherein we handhold the students from the day one till the end of the session. So I would suggest, please do register, have a look at the website, and if you are interested, please do call us. The phone numbers are there in the description below the video. Yeah, that's about it. Let's start the revision session. Today, what we will be doing is we'll be looking at few of the questions from the December 2019 CMA question paper. So this is the question paper which I downloaded from the institute website. So instead of solving the entire question paper at once, I thought maybe we can split this into different parts so that it won't be too long as such. Otherwise, it may take too much of time to just solve everything at once. I don't know if at all you think that solving the question paper at once would be more ideal. Please do let us know. So if there is positive feedback for that, we'll probably try that too. But for now, I'll be solving about 25 to 30 questions from this question paper, that is December 2019 question paper. If at all there is any problem with the audio, please do let me know. I hope the volume is fine and also the screen is visible. Okay, let me quickly go through the instructions here. Time allowed is 3 hours and total number of questions is 100. Of course, maximum marks is also 100. So that is there. Then what else? The rest of the stuff I don't have to go through. You already know what is what. So negative marking is there. That is one thing which is the unique thing here. There will be negative marking for wrong answers in the ratio of 1:4. That means 0.25 will be the deduction if at all there is any wrong question or wrong answer rather. Okay, fine. Let's start solving questions. First one. Okay, so we'll start with part 1 itself. The part 1 is of course from the accounting part, whereas part 2 is the management accounting part, which is not there in the new syllabus. I'm sure you already know that. Now let us start with this first question, which is about mines. Okay, let me just zoom in the question so that it's clearly visible for you as well. Mines as an asset is an example of dash. Mines as an asset is an example of current asset, vesting asset. What is this vesting asset? Okay, then fictitious asset and intangible asset. Okay, vesting asset is usually mentioned with respect to ESOP. Even there it's more of a liability. Then current asset, we know something which whose utility gets exhausted in just about a year or 12 months. So that would be the current asset, whereas mines obviously is not a current asset because the utility of that will last for some time. Usually mines is in the nature of what? You can say fixed asset. Fictitious asset, definitely not a fictitious asset. intangible asset, given the options, as Naseem Hashmi here says. Good evening. Yes, Naseem, I think among the options, intangible asset, but again, intangible asset here, how can you consider that as an intangible asset? It is actually an asset, no? It's a physical thing, mines. So you can't even consider intangible asset. So definitely not current asset. Vesting asset, no. Fictitious asset, definitely not fictitious. Nor is it an intangible asset. So in this case, the right answer is none of the above. But unfortunately, we do not have that option. I was also confused when I looked at the first question. Then when I actually went through the guideline answers of the institute, then I realized this is not vesting, it's a printing mistake. It should have been wasting asset. That is the right answer. Unfortunately, the institute did not print the right answer, so that's why we have this. So wasting asset, in the sense, most likely what they meant, we can only surmise as to what they exactly meant, because institute doesn't even give us the explanation when it comes to the guideline answer. So all it does is just tell us the right answer, that's all. In this case, wasting asset, I'm assuming the utility of mines, let's say if a mine is valued or the life of the mine is 10 years, every year the value comes down because of the mines extracted. So for that reason, maybe they think it's a wasting asset. So that is the right answer, unfortunately. Not among the options. Okay, there is a printing mistake here. The very first question, imagine a student's plight opening the question paper and the very first question all you have is this. Okay, anyway, at the time of preparation of balance sheet, capital work in progress is shown in the head of dash. So now capital work in progress, obviously it won't come under share capital. Okay, share capital will only contain the share capital, which comes under the shareholders funds anyway. So what is capital work in progress? First of all, it refers to the costs that have been incurred but, let's say, not yet capitalized for a project, maybe some under construction or under development project. So we have started the project, maybe we are constructing a bridge, maybe we are constructing a building, or maybe we have taken up some project whose work is in progress, but we have not yet completed it, but there is some amount of investment right now, as of now. So it could be land, construction, installation of some machinery which is not complete yet, maybe some research and development cost. So it is not yet complete. So but once it is completed, it will be obviously in the nature of a fixed asset, or in other words, it will be in the nature of a non-current asset. So non-current liability is not possible because we are building something, we are constructing something, maybe we are coming out with a new technology for which we are doing the research right now, but that research is not yet complete. But once it is complete, it becomes an asset. So what type of asset? An asset whose benefit lasts long. That means it's a fixed asset, or in other words, non-current asset. So the right option in this case would be option D. Okay, let's move on. As per the guidance note at the end of the year, as per the ICAI guidance note, at the end of the year, the balance of share options outstanding account should be shown under dash. So this again is a pretty straightforward question. For this, you'll have to look at the ICAI guidance note. So under that, they have very specifically mentioned that share options outstanding account should be shown under the category of reserves and surplus. So you can just search for ICAI guidance note and search specifically for share option outstanding account. There in one of the paragraphs, they have mentioned where exactly to show this outstanding account of share options. So again, as we progress, you will also notice that not every question is of practical nature. So there are few theory questions. I would say 50% would be at least theory. So you'll have to be careful and you'll have to remember stuff. So for that you'll have to read stuff. So I'm assuming that by now you would have gone through the material once or twice at least. Anyway, now fourth question, which brings us to our first practical problem here. Shiva Limited forfeited 4,500 equity shares of rupees 10 each. Okay. Then forfeiture. What is forfeiture? Forfeiture is nothing but cancellation. Maybe one of the shareholders did not pay the full amount, so therefore we are cancelling the shares of that particular shareholder. So how many such shares are cancelled in this case? 4,500 equity shares of rupees 10 each, which are issued on 40% pro rata basis. So here lies the crux. So now 4,500 equity shares are forfeited, but they were originally issued on pro rata basis. That means proportional basis. They did not apply for 4,500 shares, but they would have applied for something else. Based on that, we have actually allotted them 4,500 shares. So now what is that proportional basis? Proportion means there will be some kind of ratio here. So that ratio can be easily identified from the question itself. Okay, they have already directly mentioned the proportion in which they have issued the shares is 40%. Okay, that means if you apply for 100 shares, you will only get 40. So if you apply for X number of shares, you will get 4,500 shares. So that means for how many shares did this particular person apply to get 4,500 shares? So that's very simple. 4,500 into 100 divided by 40. This will give us the number of shares this particular shareholder applied for. So let me just quickly bring the calc. 4,500 into 100 divided by 40, which gets us 11,250. So now what is this 11,250? 11,250 is nothing but the number of shares which the shareholder applied for. So once they applied for 11,250 in the ratio of 40%, we have allotted them how many shares? 4,500 shares. Now this is obviously not the problem. The problem is way beyond this. Let's read the problem fully now. So again, as you can notice here, these type of problems will take time. That's why the entire paper is not full of practical questions. It is not practical also to set such a paper because you won't have the time. So theory questions, you look at it, you answer it straight away. There is no question of thinking there. Whereas when it comes to practical questions, you will have to think a bit. So that's why we have kind of 50-50 percentage when it comes to theory and practical questions. Okay. So now 11,250 is what we applied for. Let's look at the rest of the problem. Let me just zoom in. For non-payment of allotment at the rate of 6, including premium of rupees 2.5 and first and final call of rupees 3 per share. Okay, they have mentioned the various stages here and what is the actual amount also with respect to particular stage. So those things have not been paid. So what is not paid? Allotment has not been paid for by this shareholder. Also, they have not paid first and final call money. So allotment including premium is 6, that is 3.5 plus 2.5. Then final call is rupees 3. So in total they have not paid so much. So now this is 9 rupees and the premium is 2.5. So what might be the issue price? Issue price will obviously be, so if you go by this, 12.5 is the issue price. 9 is collected through allotment and first and final call. So which is the other stage which is missing from the mix here? The only thing which is missing, which is not directly mentioned, is the application stage. So allotment 6 rupees given, first and final call given 3 rupees, 12.5 is the issue price also given. How do we know it is 12.5? 10 rupees is the face value. On top of that, there is a premium of 2.5 mentioned in the problem. So therefore 12.5 is the face value. So how much is left now? So amount which is left is only 3.5, which is nothing but the application money. So this is not mentioned directly in the problem, but instead they have indirectly mentioned in the problem. Okay. So now this fellow, whosoever shares are forfeited now, has paid the application money, but has not paid the allotment and first and final call. So now if he has paid the application money, how much money has he paid? Because we have to identify what amount should be credited to shares forfeited account? A very easy question actually. They haven't asked us to find out the capital reserve. Then it would have been slightly more cumbersome or time consuming. Not cumbersome, but time consuming. But now, what is this shares forfeited account? Shares forfeited account represents the money already received from the shareholder whose shares are now being forfeited. That means whatever he has paid so far, that is the amount which you are looking for. Okay, Naseem says option A. Let's see if it is actually option A. So now how much money have we received? That money will be credited to which account? Shares forfeited account. Now how to calculate how much money we have received? Very simple. Number of shares which he applied for. We have already calculated this. If you go back, you can notice that the amount, the number of shares which we calculated is 11,250. Number of shares applied into application money. How much is the application money? 3.5. Number of shares which he applied for, 11,250. So 11,250 into 3.5 gives us 39,375. So now this cannot be credited to share forfeiture account because we would have obviously used for allotment, application, etc. etc. No? So therefore now, out of the money which we have received, how much is used towards the shares allotted? How many shares have we allotted to this person? So 11,500. What is the application money of those 4,500 shares? 3.5. So this is what he has received. We have given so much of shares. Actually, that is also not required. Now, why do we need? All that we have received is 39,375. Anyway, we are not refunding this 39,375. How does it matter how much is towards application, how much is towards allotment? Actually, it doesn't matter. We can stop here itself. So this will be the amount which will actually get credited to shares forfeiture account because we are cancelling everything anyway. So how much? 39,375. Do we have this as part of option? Yes, option C or option 3 is the right answer. Let me know if there is any doubt. We don't have to even go further actually, otherwise we'll be simply wasting time. So all that they have asked is amount to be credited to share forfeiture account. Which amount will be credited to share forfeiture account? The amount which you have received. And what happens to this share forfeiture account? What is the nature of this? The nature of this is very simple. It is nothing but profit to the company. How is this profit to the company? See, we have received 39,375. How many shares have we issued to this person? 0. We had initially issued 4,500, but then we cancelled. No. So therefore nothing is issued, but whatever we have received, that is 39,375, is our pure profit and nothing else. Of course, it is a capital profit because it is not profit which you have derived from our day-to-day business, which is something which we have received from balance sheet transaction. So therefore transfer to capital reserve. Okay. Nasim, it's okay. We are here to practice, so don't worry even if you get it wrong. So we'll see. Okay. So I hope it was easy to answer this. Let's move on to the next one. So the first practical question was actually not very difficult. In fact, it was easy only. All we had to do was calculate the number of shares applied multiplied by the application money. Done. It will take some time, of course. You won't be able to solve in seconds, maybe a minute or so. Let's move on to the next one. P Limited forfeited 5,000 equity shares. Once again, they have asked question based on forfeiture. Let's see. P Limited forfeited 5,000 equity shares of rupees 10 each for non-payment of the first and final call of rupees 2.5 per share, which were issued at a premium of rupees 3 per share, receivable at allotment. Okay, that means 10 rupees is the face value plus 3 rupees is the premium. So therefore issue price is 13. So out of 13, they say first and final call is 2.5. Okay. So remaining would obviously be application plus allotment. Okay. Both put together. Fine. Now, what else do they say? Out of these shares, 3,200 shares are reissued at 8 per share as fully paid up, etc. etc. The amount transferred to capital reserve. This will take some time. Okay. Fine. So now what we have to do here is we'll have to calculate how much is the money which we have received. We have received application and allotment also contains the premium. The only thing which he has not paid here is the first and final call for rupees for those 5,000 shares. Okay, fine. So now application money. How much is the application money? First let us do this math. So now 13 minus 2.5. 13 is the total issue price minus first and final call. 10.5 will be the application plus allotment money, including the premium is 10.5. If I remove premium and if I only consider that money which is towards the capital and which is available for transfer to capital reserve, then I'll have to remove premium from this. 10.5 minus 3 rupees, 7.5 towards share capital. This is what we can transfer to what is that capital reserve. Anything which you have already collected towards premium cannot be transferred. Anything which you have already collected towards premium cannot be transferred. Securities premium restrictions regarding that, section 51(3), I don't remember, just check. 53, 51, 55, one of these sections. Okay, of course, of Companies Act. So now towards share capital 7.5 is there. Okay, now 7.5 is what he has paid, but how many shares are forfeited? 5,000. No, there is no pro rata allotment, right? No pro rata, just straightforward. So 5,000 equity shares into rupees 7.5. So how much will this be? 5,000 into 7.5. So this will be 37,500. This is the amount which we have received from this shareholder, by the way. Okay. So now whatever we have received cannot be directly transferred to capital reserve. Two things here. One, even though we have forfeited 5,000 shares, not all of those 5,000 shares have been reissued. If you look at the problem, they say out of these only 3,200 shares have been reissued. Okay, so we'll have to be careful here. So we'll have to calculate the proportional share forfeiture balance for those 3,200 shares and then transfer that to capital reserve. So not so fast. So therefore, let's yeah. So not only that, there is one more thing which is important here. If you read the last line of the problem, they say out of these 3,200 shares are reissued at rupees 8 per share as fully paid up. That means when they have reissued, they have given a discount of rupees 2. We say shares cannot be issued at a discounted rate, but then here they have issued shares at a discounted rate. Don't worry, there is a formula which you need to take care of when forfeited shares are reissued. Normally in the problems you don't have to worry about that, but just so that you understand how exactly this thing works, have a look at this. Amount already received towards the forfeited shares, by the way, plus reissue price, okay, should be greater than or equal to face value of the shares. That's all. As long as this formula is satisfied, then you don't have to worry. If this formula is satisfied, then there is no question of discount, because we have already received some amount. Now in this case, how much money have we received already? 7.5. We already saw how we got 7.5. plus reissue price is how much? Reissued at rupees 8 per share, they say. Okay, plus 8. Is it greater than or equal to face value? Obviously yes. So therefore no problems here with respect to reissue at discount, but the company is still getting too less compared to face value. There is some amount of discount, even though we are not violating the provisions of Companies Act. So now where is this loss coming from, or how is the company making up that loss? Very simple. When a shareholder has paid some amount, let's say application, allotment, whatnot, and later on he doesn't pay the future calls, maybe up first call, second call, final call, whatever he has paid will be with us once we forfeit the shares for non-payment. So that is our capital profit. Okay, yeah, Priyan says from the share forfeiture account. Exactly, it will come from the share forfeiture account, as I just now mentioned. Whatever goes to share forfeiture account is our capital profit. So this 8 rupees or 2 rupees, 10 minus 8, 2 rupees discount will also come from that capital profit. So this is a capital loss, by the way. because we are issuing at 2 rupees loss. So this will be satisfied, or this will be made up by using share forfeiture account. So now what we have to do is we'll have to calculate the amount of discount which we have allowed. Okay, that is also easy. How many shares are reissued? If you read the problem carefully, only out of 5,000 forfeited shares, only 3,200 shares are reissued at what? 8 rupees. Okay, so now don't have to worry about 8 rupees. So the discount per share is rupees 2. So 3,032 2s are 64. So 6,400 is the actual discount. Now one more thing, we can't transfer or use this entire 37,500 now while transferring the amount to capital reserve because of one reason. What is that reason? Even though we forfeited 5,000 shares and collected 37,500 on account of those forfeited shares, we have not reissued entire 5,000 shares. We have only reissued out of 5,000 only 3,200 shares. So we'll have to calculate the proportional share forfeiture balance like this. 5,000 shares, the share forfeiture amount is 37. How much was that? 37,500. For 3,200 shares, what will be the balance? Now this balance minus that discount will tell us the amount to be transferred to capital reserve. I know this can be confusing, but once you get the logic, then you don't have to even remember anything here. Okay, so now do the math. 3,200, 37,500 into 3,200 divided by 5,000. So that means for those reissued shares, the forfeiture balance, the proportionate forfeiture balance is 24,000 only. Out of this 24,000, how much is the discount which we have issued? 6,400. So 24,000 is the proportionate amount lying in the share forfeiture account, because only that can be transferred because they have been reissued. Out of that, what is the discount? 3,200 into rupees 2 per share, because 10 rupee shares were issued at 8 rupees, 2 rupees is the loss. So therefore what is left? 24 minus 6,400 would be 17.6. So 17,600 is what will be now transferred to capital reserve. So option D is the right answer. Okay, yeah, Priyan has also answered. 17,600 is in fact the correct answer. Let me know if there is any doubt. Okay, so that was our question 5. Of course we will have to go slow here because these type of questions requires time, but in the exam my guess is you should not take more than 2 to 3 minutes. Even 3 minutes is too much. 2 minutes should be sufficient. Okay, see, it's a simple thing. See, 40 questions, or let's assume that 50-50. Why? For simplicity's sake, I'll assume 50 theory questions, 50 practical questions. So 50 theory questions, even if you consider 1 minute for one theory questions, which is too much in fact, 50 minutes. Okay, so how much time is remaining with you? Little more than 2 hours is with you for 50 questions. So that means you will get roughly about 2.5 minutes, 2 minutes something, few seconds for every question, every practical question, which is also too much only. I mean, you can still manage. So why in the exam it will be much more easier is you won't require 50 minutes for 50 theory questions, because you will see, you'll answer. Maybe you'll think for even 30 seconds. So that means even if you think for 30 seconds, you'll only need 25 minutes to answer the theory questions. So that means you'll have 2 hours 25 minutes for 50 practical questions. So that means 120, 145 divided by 50. So roughly about 3 minutes for every practical question is what you'll actually get in the exam, which according to me is more than fine. Okay. Anyway, so that was with respect to question number 5. Let's move to the next one. Okay, question number 6. Let's see. C Limited invited applications for the issue of, okay, once again, issue of shares. So see, there are so many questions from issue of shares. Usually it's a chapter from where they ask lots of questions. Even in the old syllabus, they did the same thing when the format was of descriptive nature. Now also they're doing the same thing. I'm sure in the new syllabus also they will do the same thing. Okay. Anyway, now let's read the question. C Limited invited applications for the issue of 20 lakh equity shares of rupees 10 each payable, rupees 3 on application and 7 on allotment. Okay, simple, straightforward here. 3 application, 7 allotment, done. No premium, nothing. Applications were received for 35 lakh equity shares. Okay, over subscription. Application for 11 lakh shares, sorry, 7 lakh shares were rejected. So that means out of 35, only 28 are allotted. Obviously, pro rata. You don't even have to look at the next sentence, because if 35 lakh applications have been received and out of that you have rejected 7 lakh, so that means what is the number of applications for which you have allotted shares? 28 lakh applications. But even though we have allotted shares to 28 lakh applicants, how many shares are there for allotment? Only 20 lakhs. So that means there is some kind of ratio involved here. If someone applies for 28, they will get 20 shares. Okay, so that is the ratio. You can further simplify that, but I'm just keeping it as it is for easy calculation. Next, so let's go ahead. Then what else do they say? Applications, that is no excess application money was suggested on the sums due on allotment. See, in case of pro rata, we always do that. Whatever is the excess which we have received, that we will adjust it towards the next stage. We don't have to return that money. Why we will get excess, we will see in a minute. But for now, remember that someone would have paid extra while applying for the shares, because they wouldn't have received whatever they applied for. They might have applied for 28 shares, but they would have received only 20 shares. Whatever they have applied for 8 shares, that is extra, we will not return to the shareholders, but we will keep it with them. I mean, we will keep it with us, the company, and we'll tell them, look boss, anyway allotment stage will be due in let's say 3-4 months. When you are supposed to pay the allotment money, we will tell you how much you are supposed to pay, because 8 rupees it's already with us, which we will apportion towards the next installment, which is nothing but the allotment. So this is how it works in theory. Practically this will never happen. Why? Because companies will never issue shares in installment basis. Who will do all this nonsense? Tell me. So this is an outdated topic, but nevertheless it's there for us to understand the journal entries basically and calculations. Okay. Anyway, so now Ravi could not pay allotment money on his 2,500 shares. Allotted shares. This is important. Allotted. The word allotted is the most important there. The amount to be received on allotment will be dash. How much money are we supposed to receive? That is the company during the allotment stage, accounting for one shareholder Ravi who did not pay for his 2,500 allotted shares. Okay, so now why is the stress on the word allotted? Very simple. Here, if he is allotted 2,500 shares, doesn't mean that he also applied for only 2,500. Why? Because this is pro rata allotment. No, you can't get whatever you apply for. You would have applied for in excess. For example, we have already seen the ratio. If one applies for 28, one will get 20 shares. If one has already got 2,500 shares, what would he have applied for? Simple calculation. So 2,500 into 28 by 20. So how much will this be? 2,500 into 28 by 20. So he had applied for 3,500 shares. When he applied for 3,500 shares, based on this proportional calculation, we allotted him only 2,500 shares. But since he applied for 3,500 shares, he would have also paid for 3,500 shares, which we will adjust towards the next stage, which is the allotment, whatever is the excess, the difference of 1,000 shares. I hope it makes sense. If there is any doubt, please do ask. Anyway, open the chat window. You can always ping me there. Anyway, now the question is, how much money are we supposed to receive during the allotment stage after considering the fact that Ravi does not pay for his how many shares? 2,500 shares. Let's do the calculation now. So first we have to understand how much money did we receive in total. We received applications to the extent of 28 lakhs, ignoring that 7 lakh which we anyway refunded. Okay, so 7 lakh which we anyway refunded. So for 28 lakhs, how much money did we get? So 28 lakhs into what is the application? 3 rupees. Do the math. 28 3 is how much? 28 into 3, 84. So this 84 is what we have received. Okay, 84 lakhs, it's more than that, no? 28 lakhs. Is it 84? Oh yeah, 84, no. Why am I getting confused? Okay, 84 lakhs. But we allotted only 20. So 20 lakhs into 3, which is 60. Fine, no issues here. So that means how much money do we have in excess right now during application stage? 24 lakhs is what we have in excess. Okay, this is the applications received or application money received. Application money received and application money used. We have only used 60 lakhs out of 84 lakhs which we have received. That means 24 lakhs is with us, which we will use during the allotment stage. Now let us try to calculate the allotment money due. So now how much is the allotment money? 7 rupees. So we have 20 lakh shares into 7. So 14, that means 1 crore 40 lakhs. So this is the amount due from the shareholders. Priyan has already answered. He says it is 1 crore 58 lakhs. Do we have that as option? 1 crore 15 lakhs. Okay, this is the answer which Priyan has mentioned. Let's see if that is correct. So now, once again, coming back to the question, to the solution. We have issued 20 lakh shares and application allotment money is 7 rupees. So 20 lakh shares into 7 rupees, we are supposed to receive 1 crore 40 lakhs. But we have already received some amount in the application stage, no? How much? This much. 24 lakhs. So 140 is what we are supposed to get, but out of that excess adjusted from the previous stage installment, how much? 24. So 140 minus 40 minus 24 is 16 anyway. So 1 crore 16 lakhs is what we are supposed to receive. Allotment due. This is an amount which you are supposed to receive, not the yeah, okay, anyway. But we did not receive this 1 crore 16 lakhs for one reason. Why? Someone holding 2500 shares did not pay the allotment money. So now let us go back to Ravi. Now Ravi did not pay 2500 amount towards 2500 shares. Okay. So but he had already paid some amount excess, no? Because when he applied for 3500 shares. So let us do that math now. 3500 applied by Ravi into application money 3. So 3 3s are 9, 3 5s are 15. So that means 10,500. So this is what we received when he applied for those shares. But how much did we allot? Only 2,500 shares. So that means we utilized out of 10,500 which he has already paid us only 7,500. So that means remaining 3,000 is still with us. Extra or excess money lying with us. Of whom? Of Ravi. Okay. Who, by the way, did not pay the allotment money. So now tell me, how much was he actually supposed to pay? He was supposed to pay on his 2,500 shares allotment money of rupees 7. Okay, 25 sevens are 175, so 17,500 is what he was supposed to pay, minus which he has already paid during the application stage, which we just now calculated 3,000. So when you do the math, how much did he not pay now? 14,500. This is what we did not receive now. 14,500. So how much were we supposed to receive? 1 crore 16 lakh blah blah blah, and out of that how much did we not receive? 14,500. So 1 crore 16 lakhs minus 14,500, it should be 85,500. Actually this, without even looking at the calculation, we can easily identify whatever Priyan mentioned is correct, but just for confirmation sake I will just calculate this. Minus 14,500. So 1 crore 15 lakhs 85,500 is what we will receive from the allotment stage. Okay, fine. Let's move on to the next one. See, it took some time actually. It will definitely take 3 minutes at least in the exam. I don't expect you to solve within 3 minutes these type of problems. Of course, it also matters as to how confident you are. The more confident you are, the more it is easier for you to solve quickly. Anyway, so next, let's move on to the next one. Okay, this is a theoretical question. That is nothing much here. Rule 17 of the company's share capital and debenture rules 2014 is related to dash 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 issue of right shares, buyback shares or other securities, issue of sweat equity shares, employee stock option plan. Again, this is purely based on memory. So this is regarding buyback of shares. Okay. So basically what rule 17 tells us, that the company must have authorized where in its articles of association to do what? To buy back its own shares. If there is no authorization in the articles itself, then there is no question of buying back. So where is this mentioned? Rule 17. Then what else does it say? The buyback must be authorized by the board of directors through a resolution, and company must file a declaration of some solvency with the ROC. That is another thing. Then what is the source of the buyback? That is also mentioned. Maybe you can use your free reserve, securities premium account, or maybe proceeds of some other shares or securities. That is also there. Then what else does this rule 17 mention? It also tells us what is the maximum limit for the buyback. How much is the maximum limit in with respect to buyback? 25%. 25% of what though? Of paid up share capital and free reserves of the company. Then what else? Once you pass the resolution, no? Board resolution or special resolution, whichever is required according to the percentage of shares being bought back, then you should complete this whole process within 12 months from the passing of resolution. So this is what is generally mentioned in rule 17 of the company's share capital and debenture rules 2014. So if you are able to remember this, then easy 1 mark. Okay, there is nothing much to do here. It's purely based on memory. Okay, let's move on. Okay, once again there is a theory question which is also related to the same rule incidentally, that is rule 17. So now in this case, let's see the question. In case of buyback of shares, passing of special resolution is not required. As I said earlier, depending on the amount of share capital you buy back, your resolution will change, whether it is ordinary or special resolution. So now that is exactly the question which they have asked, like when do we not require special resolution? Very simple. When you are buying back less than 10% of your total paid up equity and free reserves. That is option C. If the buyback, that is the amount of share capital which you are buying back, is less than 10% of total paid up and equity, so then we say special resolution is not required. Ramesh Durgendran also has mentioned the right answer. It is indeed option C. Okay, let's move on to the next question. Again, theory question. For the companies whose financial statements comply with the accounting standards as prescribed in section 133 of the Companies Act 2013, the premium payable on redemption of preference shares shall be provided out of. This is slightly tricky. Again, there is so much of company law which is also there in case of accounts. So you cannot study accounts independently. If you have already passed M1, then it's definitely advantageous for you. Or if you are concurrently studying or appearing for both the groups, then also it is advantageous for you. If let's say you are someone who is watching this video and actually preparing for December, I would suggest also read company law if possible. You have sufficient time, because so much from accounts is actually based on company law. If you already know company law, then it is easy. Anyway, so now Priyan says C. What is option C? For the companies whose financial statements comply with accounting standards as prescribed in blah blah section 133 of the Companies Act, the premium payable on redemption of preference shares shall be provided out of. Okay, basically they are asking about the source. What is the source when it comes to premium on redemption of preference shares? So again, it depends. The answer is it depends. Okay, so depends on what? Whether they are complying with the accounting standards as prescribed in section 133 or not. So in this case, they say those companies are actually complying with the accounting standards as per 133. In that case, what to do? In that case, there is a proviso. What is the proviso? Normally only the profits. Premium will be provided out of profits. Okay, but if you also fulfill section 133, then premium, if payable on redemption, can be sourced or provided out of profits as well as securities premium before the start of this redemption process. So that means if you have already complied with section 133, then it is not just the profits which is available as a source for redemption premium, but also the existing securities premium. That means whatever premium you have before the start of the process of redemption, even that will be available for you as a source for premium on redemption of preferential. So therefore, which is the right answer in this case? The right answer would be option C. Any of the either profits of the company, either profits of the company or securities premium. In fact, Priyan is right. It is option C. I hope it is clear. And one more thing, this brings me to one important point with respect to guideline answers. Few of the answers in guideline answers are incorrect. For example, this one also, if I'm not mistaken, they have selected some other option which is wrong. You can have a look at section 133. It is very clear. If some company has complied with 133, then done. You have to what? I mean, you can even provide premium based out of, premium can be provided out of existing premium also. Okay, that is the simple point there. Okay, institute is wrong there. Anyway, let's move on. Here also the institute has made a mistake. Next question, question number 10. Okay, I will give you a minute to answer this because it's a very easy question. Okay, CRR can be used for what? For what? Tell me. Capital redemption reserve can be used for what? For what purpose? There are 4 purposes here. Issue of fully paid bonus shares, conversion of partly paid shares into fully paid, writing off of preliminary expenses of the company, and distribution of dividend among the shareholders. Okay, Ramesh as well as Priyan have answered correctly. That is option A, which is issue of fully paid bonus shares. Which section? Section 69, I believe. Sections, you can check later on. Section 69 talks about CRR, wherein it says we can issue fully paid bonus shares out of the funds lying in CRR account. Okay. Anyway, that was a very easy question. As I said, let's move on quickly to the next one. Let's not waste too much time on theory one. Next, a company offered 250,000 equity shares. Okay, once again a problem related to shares. See how many such problems are there. We are just in the 11th question. Already we have seen so many questions based on either, based on equity shares only. But this is slightly different. This is about the underwriting. I remember this question is slightly incorrect actually. Anyway, I'll tell you what exactly is the problem here. A company offered 250,000 equity shares to public for subscription. Okay, so 250,000 is what they have offered to public. Okay, so out of this 250, 70% of the public issue was underwritten by G. Someone G. Okay, so she has underwritten how much? 70% of this 250,000, which comes to 250,000 into 70%. 1,75,000 is what she has guaranteed. Okay, so now out of this there is some firm underwritten shares as well. That means no matter how many shares or how many applications you get from public, the underwriter will definitely subscribe to some amount of shares. That is what is called as firm underwriting shares. Okay, so in this case her firm had underwritten how many such shares? 40,000 shares. Okay, now they say public subscribed for 1,30,000 shares. So 1,30,000 shares was subscribed. So how much is left now? Out of 250, if 130 is subscribed for, 120 is what is left. Okay, so if 120 is left, then okay, directly we can do this, but again you will not get the right answer. Okay, so now how are we supposed to calculate this? See, now they have given one more note to us wherein they have specified that what is the net liability of G underwriter if as per underwriting agreement no credit is given to the underwriter for her firm underwritten shares. That means we are disregarding 40,000 for now in this 120. That means they have not told us whether whatever the public have subscribed that includes whatever she has subscribed, or does it not include? Because there is something known as marked applications, unmarked applications. Marked applications means those applications which will have the stamp of whom? Underwriter. So how many such marked applications have we received? No idea. What about the public applications, that is 1,30,000 shares? Does it include firm underwriting? No idea. Have they asked us to assume anything? No idea. Okay, so there is so much of missing information in this question. Okay, at least they should have mentioned how much is the marked application. Now if 1,20,000 is what is due, out of this how much will be the underwriter's liability? Only 70%. So 70% of 120, 7 12s are 84. This comes to 84,000. So now they have very clearly mentioned don't include firm underwriting in this 84. Okay, we will add it separately. Plus how much is the firm underwriting? 40,000. So when it is total, it will be 124. So this will be her gross liability. How much? Or net liability actually. 1,24,000 shares. It is not there in any of the options. So therefore we can't choose this. I think they have mentioned 85,000 as the right answer. I don't know how they got that 85,000. Okay. So I believe this is the right answer. 1,24,000. Okay. Fine. Let's move on. Next. This is a very simple question, theory question. The entry debenture suspense account debit to debentures can be passed. See, debenture suspense is a fictitious account. There is no such thing as debenture suspense. We use this debenture suspense for one and only one reason: when company has borrowed some money as loan, and whoever has granted such loan, they want some additional security. Additional security, collateral security. So now we have already given some, let's say, some asset as security. On top of that, they are asking for one more thing. So okay, we will do one thing, we will issue debentures. When we say when we issue debentures, are we getting any money? No, obviously not, because they have already granted us the loan. Why will they give us extra money on top of whatever they have already given as loan? So there is nothing which we are receiving, but we are simply issuing. That means that is the entry which we have passed. Debenture suspense account debit to debentures account. This is a fictitious asset which we are creating. This is a fictitious liability which we are creating. Okay. So once that loan is cleared, we will simply reverse this entry and cancel whatever we have shown in the asset side and liability side of the balance sheet. So that is the thing. Option B, collateral security, additional security. So for that reason only we issue debenture suspense, for no other reason. Let's move on to the next one. Okay, question number 13. Once again a practical question. Once again the institute has made a mistake. Let's see what exactly they have done. C Limited issued 8% debentures of rupees 65 lakhs at 5% discount, which are redeemable at a premium of 10%. On recording the transaction, loss on issue of debentures account will be dash. Okay, let us record the transaction straight away. So now first of all, bank account debit. So how many such debentures? Okay, 65 lakh at 5% discount, no? So 65 lakhs into 95% is what we have received. 61 lakhs 75,000. Okay, so this is what we have received. How do we know this? 65 lakhs is the face value of the debentures, but issued at 5% discount. So therefore what I did here was 65 lakhs into 95% is what I calculated. So we get some amount, that is 61 lakhs 75,000 basically. 3,25,000 is what we have not received. So that is, I will call it as discount on issue of debentures debit. 65 lakhs into 5% basically, which comes to 3,25,000. That is one thing. Then further they say which are redeemable at a premium of 10%. That means while returning the money to the debenture holders, we will be paying extra 10%. If it is 100 rupee debenture, we will be paying 110 rupees. So that is a loss. That is the actual loss which we are facing. So now that loss will be on the face value. How much is the face value here? Face value is 65 lakhs. 65 lakhs into 10%, 6,50,000. So now let us call it loss on issue of debentures debit, 6,50,000. Okay, 2 what is the percentage? 8% debentures, 65 lakhs. to premium on redemption of debentures. How much is the premium there? 6,50,000. 6,50,000. That's it. So now if you look at this entry, where is the loss here? There's only one loss, no? How much is that loss? That loss is nothing but 6,50,000. So the right answer should have been 6,50,000. I think the institute has mentioned 9,75,000 as the right answer, which is wrong. Okay. If you actually look at their own study material, I'm not referring to any other book. I'm going by institute study material. The institute can be so stupidly inconsistent. How? See this. So discount on issue of debentures, this is how they treat it. Okay. So here if you look at this, issued at discount and redeemable at premium. That is what our situation is right now. What is the entry? Bank account debit, we debited bank account. Discount on issue of debentures account debit, we debited that too. Then he says loss on issue of debentures. What is that loss? With the premium payable on redemption. So how much is the premium payable on redemption in our case? It is 6,50,000. So that should have been the loss. So here they have answered incorrectly. So then of course the rest we know already. We have done that. Anyway, so be it. Institute is institute for that reason. Let's move on to the next one. So 13 questions done. 14th one. Okay, let's read the question first. M Limited issued 8% debentures of rupees 60 lakhs on 1st January 2019 at a discount of 10%. Okay. The debentures are redeemable in 3 equal installments of 20 lakhs each payable on 31st December every year. Okay. The amount of discount to be returned at the end of the year on 31st March 2021 will be dash. Okay. Easy actually. You don't have to even calculate this now. So now 60 lakhs debenture, you are redeeming 20, 20, 20. Okay. At the same time, you have discount of 6 lakhs. If discount is 6 lakhs, that will also be written off with respect to the debenture outstanding. Okay. So if you calculate the debenture which is outstanding, so first year it will be 60 lakhs, then it will be 40 lakhs, then it will be 20 lakhs, no? Then fourth year it will be 0 actually. Yeah. At the end of first year you will still have 60 lakhs. Okay, because this is which year? They were issued in 2019, 2019, 2020, 2021. Then finally 2022 and we will have 0. Okay, because obviously in whatever was there we have already written it off. So number of 642 or 3:2:1. If that is the case, 6 lakhs into 3 by 4, 5, 6, no? So that means half, 3 lakhs here. So 6 lakhs into 2 by 6. So this will be 2 lakhs. Then lastly it will be 1 lakh. So looks like the option is 1 lakh. I don't know what is the answer. I think they have selected 1,75,000. I wonder how they got 175. You won't get 175 now. So it is based on the amount of outstanding debentures. Based on that we have issued, we will get this ratio 1:2:3. So they should have divided in this ratio. Discount on issue is also considered as loss only, is asking Priyan. It is always debited to a separate account. So I'm purely going by the institute material. See, if you go by this material, loss, they have maintained a separate account for that. For discount, they have maintained a separate account. Okay. So we can't club both. But in the exam, they have clubbed it. I mean, preparing the guideline answers, they have clubbed it. So that means they are inconsistent in their approach. Can't do much about it. Okay. We can't do anything. We'll just go by that. Okay. See, whatever is correct, please do that, because sometimes what happens, the institute might have printed something. Later on, someone would have suggested them, told them that this is wrong. So you will obviously get grace marks, or if someone has written the answer correctly, you will obviously get the right marks. So you go by what is correct. Don't go by what the institute says. Okay. Normally, what the institute says will be what the correct thing, but sometimes they also go wrong. But in this case also, I don't know how they got 1,75,000. Anyway, I think it is 1 lakh. Don't know how they calculated it. Okay, let me just slightly change the situation here. If only the debentures were redeemable, let's say only at the end of the last year, there is no redemption happening in installments, everything is redeemed at the end of the third year, then what? In that case, whatever is the discount now, 6 lakhs, okay, this 6 lakhs will be divided by 3 years. So that means every year you will redeem, you will write off 2 lakhs, 2 lakhs, 2 lakhs. When the number of outstanding debentures or the amount of outstanding debentures is constant. But in this problem, it is decreasing. Finally, it becomes 0. Okay. So therefore, you'll have to be careful in such problems. Or even if you consider this, let's assume for a second that they consider 40 lakhs here, 20 lakhs and 0 lakhs here. In this case also, we can't do that because there is no question of 0 here. No, our earlier calculation was fine. 3:2:1 is what we have to do. Unfortunately, they have not done. That's okay. Let's move on to the next one. Question number 15. Okay. Yes Limited had issued 80,000 8% debentures of rupees 100 each, redeemable on 31st December. Okay. 2019 at a premium of 20%. Okay. The company offered 3 options to the debenture holders, out of which one is to convert their holdings into equity shares of rupees 10 each at a premium of rupees 3.5 per share. Okay. So this is nothing but the conversion of existing debentures into equity shares. Okay. See what happens here is, at the end of the life of the debentures, they will have the option either to convert their existing debentures into shares, or redeem the debentures and get the money from the company, which is the natural course. So in this case, the company gave that option to the debenture holders. Okay. So one of the option was to convert their holdings into equity shares of rupees 10 each, but at a premium of 3.5 per share. So that is what was given as an option. Okay. So now when that is the case, how much or how many shares, number of equity shares will we have to issue to make up for their worth? Okay. So that is the thing. Let's see. So now how many accepted the offer? Only 49,275 debentures, they accepted this offer. So first of all, we'll have to calculate how much is due to these debenture holders. See, we would have paid how much? 100 face value plus premium of 20 rupees. So how much is due to them? Okay. So that means 49,275 into 120. So we are supposed to pay 59 lakhs 13,000 to these debenture holders. Normally, we would have paid so much if they had not exercised this option of conversion. But they did. Since they did, we are giving them how much? We are issuing them shares, but not just ordinary shares, shares with a premium of 3.5. That means every share will be worth 13.5, 10 rupees plus 3.5. So that means this divided by 13.5. So divided by 13.5, 4,38,000 equity shares is what we have to issue to these debenture holders to convert their existing debentures into equity shares. Priyan has already answered correctly. Very good. So that is the thing. Let me know if there is any doubt. Okay, let's move on. Okay, one more question based on debentures, but in this case, cum interest, ex interest. Okay. Now, question number 16. This is. Let's read the question first. G Limited has 8 lakhs 12% debentures of 100 each. Okay. During the 18-19 year, the company purchased its own debentures from the open market for immediate cancellation. Twice they purchased. Once in August, ex interest, and once in Jan, cum interest. Let me quickly tell you what is ex interest, cum interest. I know you know, but still. Sorry. Ex interest means we will be paying interest separately apart from whatever we are paying for those debentures. Now in this case, in August, for 15,000 debentures, they paid 95.5 per debenture. That means interest is excluded from this 95.5. We'll be paying interest extra separately. Whereas when they say come interest, this 101.5 also includes whatever interest is supposed to be paid to them. That is the thing. Now let us read the question. If debenture interest is payable on 30th September and 31st March every year, half yearly debenture interest, then the amount of profit or loss on cancellation of the debentures is how much? How much is the money which we are making by cancelling these debentures in the open market? Are we making any money here? If so, how much? That is the question. So now, first of all, let us calculate how much is the amount actually due and how much did we actually pay. Now let us first look at the August 1st transaction, then we'll go to the January 1st transaction. In August 1st, we cancelled 15,000 debentures. If you are cancelling 15,000 debentures, you should have paid at least face value 100 rupees, because that is given, no? Debentures over rupees 100 each. So this comes to how much? 15 lakhs, no? Yeah, 15 lakhs. This is what we were supposed to pay. But how much did we end up paying? 15,000 debentures into only 95.5, excluding interest, but interest, it has its own calculation. We are not worried about interest. So 15,000 into 95.5. So we paid only 14 lakhs 32,500. That means we made a profit of 67,500 here. Simple calculation. We were supposed to pay 15 lakhs. We paid only 1432 on face value. So therefore, profit on cancellation of debentures on August 1st is 67,500. We don't even have to worry about interest here. Why? Because it is anyway X interest. If it is X interest, there is the question of even calculating the interest part, because you will pay the interest separately. It's not included in this 95.5, so don't worry about it. Now the second transaction is not so straightforward. Okay, here we'll have to be slightly careful. Let us look at it. So in this case, what has happened here is we have paid 101.5 including interest. That's why they say come interest. Okay, so let me calculate 25,000 into 101.5. How much did we pay in total come interest? 25,000 into 101.5. We paid 25 lakhs 37,500 rupees, but this includes some interest also. So now, when did this take place? This took place on Jan 1st. When did we last pay the interest? We last paid the interest on 30th September. So that means we have to now pay the interest of October, November and December. For 3 months we owe them interest, which we told them is already here. So let us try to exclude that interest and then calculate the X interest price, actual amount paid only towards the face value of the debentures. How to calculate that? Very simple. Face value 25 lakhs into interest percentage is how much? 12% into 3 by 12, because we are supposed to pay interest for how many months? 3 months only. What is the interest percentage? 12%. So 12 gets cancelled. 25 into 3, so it will be 75,000, I think so. So 25 lakhs into 12% into 3 divided by 12, 75,000. Yeah, 75,000 is anyway interest here. So remove 75,000. You will get the X interest price, the amount which we paid only towards debentures. 25, 37, 500 minus 75. So amount which you paid only towards debentures is 24 lakhs 62,500. This is the face value. Actually, we were supposed to pay them how much? Amount paid is this. Amount due is on face value. That is once again 25,000 debentures into 100. So 25 lakhs. That means what is the profit? 37,500. So that means we paid 37,500 less. So that is our profit. So here on Jan 1st we made a profit of 37,500. on August 1st we made a profit of 67,500. So both put together, how much will it be? 67,500 plus 37,500. 67.5 plus 37.5, 1,05,000 is the total profit. That's it. Easy. So 1,05,000, option D is the right answer here. Okay. I hope it is clear. Let me know if there is any doubt. I will be just moving from one to another. If at all you have any doubts, you should be stopping me. Okay. Okay, next. This is easy. The profit on cancellation of debentures should be transferred to. This is a capital transaction basically, because this is a balance sheet item. Any profit which we make out of balance sheet transaction will automatically get transferred to capital reserve. There is nothing else here. Okay. Next. This one was also very easy. We have already seen this section. This one we have not seen. So buyback. We saw the rules. Okay. Every buyback shall be completed within a period of dash from the date of the resolution passed or special resolution. Okay. 1 year. That's it. We have already seen 12 months from the date of the resolution or special resolution. I think this is section 68. Check later on, please confirm. 12 months. Yeah, pre-N is right. It is 1 year, 12 months. Okay. Next. Okay, we have a problem here. Problem 19. Question 19. So in this case, it is a question related to what? Depreciation. Interesting. Return down value of a machine on 31st March 2019 is 6,65,558. Return down value. So that means, okay, first of all, let me tell you what is depreciation quickly. Depreciation is nothing but the permanent reduction in the value of asset for various reasons, and one of the reasons why there is reduction in the value of asset is because of the wear and tear. Once again, depreciation is a permanent reduction in the value of asset. Why? Because of wear and tear, mainly. Okay, that is not the only reason. That is one of the main reasons. Just give me a second. Let me just turn on the light. Okay, I'm back. So now in this case, there are two primary methods, by the way, when it comes to depreciation. Which are the two primary methods? One is the straight line method, where the depreciation percentage is always fixed. Percentage, also the amount, not just the percentage. For example, 10 lakhs is the value of asset. Okay, under straight line method, if the depreciation percentage is 10, every year will depreciate this asset by 1 lakh, 1 lakh, 1 lakh. First year 1 lakh, second year 1 lakh, so on, like until 10th year, where it will always be, once again be 1 lakh, and the asset value will become 0 at the end of the 10th year. Done. This is straight line method, simple, straightforward, easy. Then comes the return down value or diminishing balance or reducing balance method, which is not so straightforward. Okay, so that is where problem arises. So if the 10 lakhs is the opening value of the asset, or the actual price of the asset, and depreciation is 10%, and we are following WDV method, then first year depreciation no change, 1 lakh will be the depreciation. Then this will be 9 lakh return down value. What is the balance? 9 lakh. Now second year we'll calculate on this 10%, so 90,000. Then this will be 8 lakh 10,000, then 81,000, so on and so forth. Now here we have to look at the second method. So that is why the calculation will not be very straightforward. It will take some time. It's not difficult, it's only time consuming, that's all. So now let us look at the question. So in this case, they very clearly have mentioned that after writing down for so many years, it is this value, no? What will be the cost of this machine purchased on 1st April 2014? Oh my goodness. We have to go way back. Okay, fine. Let's do that. Let's assume that the value of the asset was X. When? 1st April 2014, the value of the asset is X. We do not know. After reducing for so many years, 5 years, the value is 6,65,558. Okay. So if it is first year, if the value of the asset is X, this is which year? 1/4/2014, first year. Okay. Opening day. because the asset was purchased on 1st April. So full year depreciation 15% on X. So this will be 0.15x. WDV method, we'll have to reduce the balance again. Okay, Priyan has already mentioned the answer as 15 lakhs. Okay, we'll see how we got that. So now first year it is X minus 0.15, that is the depreciation. So on 1/4/2015 the balance will be 0.85x. So second year again 15% depreciation on 85, what is that, 0.85, 0.85 into 15%. So this will be 0.1275x. Because we have considered the value of asset as X, we are calculating everything for that 1 unit. Okay. So now when you do the math, minus 0.85, so we'll be left with 0.7225x. So this is 1/4/2016. Again we'll have to calculate 15% depreciation on this into 15%. So this will be 0.108375x. Okay, everything is as a percentage of the previous balance, plus 0.7225. So how much is the balance now? 0.614125x. So which date is this? 1/4/2017. We have to go till home, which year, by the way, according to the question, 2019 March. No, okay, fine. So now once again on this we'll have to calculate depreciation. 0.614125 into 15%. 0.0921185. Don't round it off in exam. This it is better if you do the calculation precisely. Minus 0.614125. So we'll be left with 0.522000625x. So this is which year? 1/4/2018. Finally, on this again 15% calculation, so which will come to 0.0783009375x. Okay, 0.522000625. So 0.4437053125. So 1/4/2019. 1/4/2019 is same as 31st March 2019. So this is the value of the asset on 31st March. Now it is easy to calculate. 0.4437053125x equals, according to our question, 6,65,558. After writing off the depreciation for all these years, the value of the asset is 665,558. So then how much is X? So that will be 665,558 divided by 0.4437053125. Do the math, you will get the answer. So 665,558 divided by 0.4437053125. Okay, I missed 5 there, but still 15 lakhs. So this will be the what? Value of the machine. So I just wanted you to understand how exactly the calculation is made. So we started from there, X, then we went down every year calculating 15% depreciation. So finally we got this value 0.4437053125. So that is nothing but the actual value of the return on value, which is 665,558. Then you divide by that 0.4 something something, you will get the, and what is that, answer. Priyan says this will be time saving. What will be time saving, Priyan? I didn't get it. Anyway, let's move on. In G Limited, it's a theory question, is it? In G Limited, there is one whole-time director and 3 part-time directors. One whole-time, 3 part-time. The 197, 198, no? The maximum rate of remuneration payable to all the directors will be dash. when there is a whole-time director and also part-time director, is 11%, if I'm not mistaken. 11%, yeah. So let me just verify this once. Managerial remuneration, I had marked this somewhere. Yeah. So when you have one managing director and many part-time directors, it is indeed 11%. You can check the material here. Maximum remuneration payable would be 11%. So when we have one managing director, whole-time director, or a manager plus others also, overall maximum remuneration which we can give is only 11% on the net profits. So that is the thing. Let's go back to the question. 11% is the right answer. Question number 20. Then once again a theory question. So when the effective capital of a company is 100 crores and above but less than 250 crores, the maximum remuneration payable as part of the Schedule 5 Part 2 of the Companies Act to its managerial personnel when company has no profits or inadequate profits is dash. We'll have to go back to that only study material. So yeah, here it is. So here they very clearly mentioned remuneration payable of a company when the company has inadequate profits or no profits. So here where the effective capital is how much? In our case 100 crore and above but less than 250 crore. So 100 crore and above but less than 250 crores. So in that case it is 120 lakhs. So that is the thing. Okay. So managerial remuneration is what is asked. So for this range of capital, the remuneration which we can give when there is no profit or inadequate profit is 120 lakhs. That is 1.2 crores basically. Next. Option C is the right answer here. 21, 22. Every company having a turnover of dash during the immediately preceding financial year shall constitute a corporate social responsibility committee. This one is 1000 crores, no? Okay, somewhere here only it is there. Corporate social responsibility spend. Every company having a net worth of rupees 500, net worth is 500, turnover is 1000 crores or more, shall constitute a CSR committee. So that means in our case every company having a turnover they have asked. So therefore in that case we'll have to select the answer B, that is 1000 crore or more. So that is the right answer. Again easy because you'll have to remember and just select the right answer. It won't consume any time at all. As I said, less than 30 seconds. Next. There's a question based on segment reporting. A very easy question actually. Question 23. Which of the following is not a type of segment? In case of segment reporting, we divide the results based on various segments. For example, geographical segment, business segment, reportable segment. What is not present in AS17 is the industrial segment. It is not there. So that is something which we do not have. So that is the right option. Which of the following is not a type of a segment? The answer is option C, industrial segment. Okay, next. Actually this is an unfair question. Nowhere in the material they have elaborated on AS17. Unless the student is familiar with AS17, they won't be able to answer this. The material does not have anything to do with AS17. They have mentioned just about one paragraph on AS17. If you are asking detailed questions on AS, please also mention what is to be studied with respect to AS, because if you expect student to study everything in detail, then AS on its own will be one huge subject which is not relevant for us company secretaries or future company secretaries. So institute can be stupid, which is not surprising anyway. So now next. 24. Equity holder of a company who does not have a voting control of the company by virtue of his or her below 50% ownership of the company's equity. Okay. Small shareholder, minority shareholder, obviously minority shareholder, no? Less than 50%. Small shareholders are those whose nominal value of maximum of how much can they have? 20,000 rupees in a public company. So then we call them small shareholders. So here below 50%, then they are referred to as minority shareholders. So that is question 24. So 25. Okay, here let's see. Oh, this is one horrible question. I hope that you won't get such type of questions in the exam. I'll tell you why it is horrible. Because the way it is drafted, okay, it's not properly drafted. The English here is horrible. So now you read this question. I will use my own words to explain this. I'm just rephrasing the question so that it's easy to understand. Forget about the question there, just listen to me. H Limited is a holding company. Okay, I'm just rephrasing the question of S Limited. H Limited is the holding company and S Limited is the subsidiary. Okay, financial year is irrelevant here. Now, S Limited has issued bills receivable. S Limited, the subsidiary, has issued bills receivable of rupees 5 lakhs to H Limited. Okay. Out of above, H Limited has already discounted. That means they've already approached the bank even before the due date, let's say 3 months or whatnot. They've got the bills discounted. That means they've already received the money. For how much? Discounted bills is 4 lakhs. 5 lakhs is the bills issued by S to H, but H has already discounted 4 lakhs. Okay. Then further they say S Limited endorsed bills worth rupees 3 lakhs to its creditors. Okay. To its creditors that were received from H Limited. I'm just looking at the question and trying to rephrase it, make it simple. Okay. So this is the situation. At the end of the year, how much is the mutual debt? That is the question now. Okay. So now let me restate the problem once again. H Limited is the holding company, S is the subsidiary. Subsidiary company has issued bills receivable worth rupees 5 lakhs to H Limited, out of which 4 lakhs is already discounted, 1 lakh is what is due. That's fine. Okay. Then S Limited endorsed bills worth rupees 3 lakhs to its creditors that were received from H Limited. Okay. So now we have to calculate the net amount of bills receivable. Net amount of bills receivable that S Limited owes, that is the subsidiary owes to holding company, after taking into account both the discounting of the bills, also the endorsement of the bills. Okay. So now out of 5 lakhs, that is the gross amount, okay, issued by S Limited. How much is already discounted? 4 lakhs is already discounted, no need to worry about it. Leaving a balance of how much? Only 1 lakh. Okay. So further they say 3 lakhs were endorsed by S to its creditors. Of what? Of this 4 lakhs. How do we know that? They have very specifically mentioned the same thing. Out of the above. Out of what? Out of whatever was issued to H Limited. Out of that, how much is endorsed by S Limited? 3 lakhs is endorsed. Leaving a balance of how much? 1 lakh. Out of 4 lakhs, if you have already endorsed, because from the point of view of S, they still owe it. They still owe that money to which is that company, H Limited. H may have encashed it, but S Limited still owes. But how much do they actually owe? 4 lakhs minus 3 lakhs, because we have already endorsed, we have passed it on. So leaving a balance of 1 lakh now. So what is the actual mutual debt now which is owed to one another? So that would be only 1 lakh and 1 lakh. That's all. Again, this should have been rephrased properly. The question is not at all designed properly. It will take at least 10 minutes to understand this question. Comma, full stop, nothing is written properly. So based on the answer, I had to understand the question. So such horrible question it is. Okay. So that is the thing. Let's move on. I hope you don't get these type of questions. And also one thing which you can take out of this is, I think this is the first attempt in new syllabus. So institute made few mistakes probably, since they were asking multiple choice type of questions in CMA for the first time. Maybe they were also not very they didn't know how to ask questions basically back then. So they made mistakes. Hopefully as they progressed they also improved. Okay, let's move to the next problem. Okay, after this we'll stop. On 1st April 2019, H Limited purchased 16 lakh equity shares of 20 lakh equity shares of S Limited. Okay, consolidation. Okay, fine. Following information is provided as on 31st March 2019 by S Limited. Fine. Sorry. Equity share capital 2 crores is there. General reserve 45 lakhs. Statement of profit 32 lakhs. On 1st April 2019, a machine of S Limited revalued by H Limited 25% above its book value of 12,50,000. Amount of minority interest will be minority interest is what they have asked. Okay, fine. Actually easy. Let me just zoom out a bit so that you can read the question completely. So now minority interest, first of all, what is the control ratio here? H Limited, that is a holding company, they purchase 16 out of 20 into 100. So this means 16 by 20 is 80%, right? So this is 80%. So if holding company has 80%, minority interest in this case would be 20%. Fine, minority interest 20%, that we know now. So rest what we have to do is we'll have to calculate 20% of whatever is available to them. Okay, share capital, starting with share capital 2 crores into 20%, because that is what they have, no, 20% share in everything. So 2 crores into 20% will be 2 are 40 lakhs. That is with respect to equity share capital. So they will also get a share from general reserve. So how much is the general reserve here? 45 lakhs into 20%. So 45 lakhs into 20% means once again 9 lakhs, no? So 9 lakhs. Out of general reserve, their share is 20%. So give them 9 lakhs. Okay, done. They will also get share from P&L, free reserves. That is also a free reserve. 32 lakhs into 20%. Okay, 32 to 64, that means 6.4 lakhs. That also goes to them. Then on top of that, there is some revaluation profit, so which will also go to them. So how much is the revaluation profit? So now this plant has been revalued 12,50,000. 12,50,000 above the book value, they say. So that means 12,50,000 into 25%. 12 into 25%. So 3,12,500 is the revaluation profit overall. But entire 3,12,500 will not belong to only minority shareholders. So out of that, their share is 20%. Remaining anyway goes to the holding company. So 312.15 into 20%. So this will be 62,500. So now total, that's all. 62,500 plus 6,40,000 plus 9 lakhs plus 40 lakhs. So 56 lakh 2,500 is what belongs to them. 56 lakhs 2,500. Okay, I hope it is clear. That's all from today's sessions. We have covered 26 questions in 1.5 hours. Again, we have to go slow here, so we'll try to cover the rest in the upcoming sessions. We will be conducting at least 2 sessions in a week, one for FM, one for CMA. If possible, I'll try to increase the number of sessions so that we'll be at least able to cover 2 to 3 papers. Otherwise, it'll be very difficult to cover in one stretch. As I said, I don't want to do it at a stretch. Then it'll be too cumbersome to watch a lengthy video. Anyway, so that's all from our side. If you like the video, if you thought that this was useful, please like this video, and if you have not subscribed, why haven't you? Please do subscribe. Okay, so Priyan says it was helpful. I'm glad, Priyan, that you found it helpful. We will be continuing this. Okay, thank you guys, see you, bye bye.